The silver market is currently in an unprecedented situation. The strain on supply chains and the stress within financial markets have reached such a fever pitch that many analysts are asking a terrifying question. Are the banks about to collapse due to their massive short positions in silver? We are seeing smoke. The question is there a fire that could burn down the financial system? In this video, we are going to explore whether a banking collapse driven by silver is actually possible. There are all sorts of different opinions about this matter, ranging from conservative denial to apocalyptic certainty. Today, we are going to look at the facts, the data, and the balanced approach that often gets lost in the hype. I found a piece of analysis that I think provides the most level-headed view of the situation. I don't agree with all of it, and I'm sure you won't either, but it is crucial that we understand the counter-arguments if we want to see the full picture. The silver market is complex, it is messy, and right now, it is dangerous. We have to cover this from a couple of different fronts and address several different claims regarding naked shorts, force majeure, and the alleged insolvency of major bullion banks. But before we dive into the data, let's establish one fundamental truth. For those of us who hold physical silver, it does not matter what the banks do. In fact, it does not matter what the Federal Reserve does or what Congress does. Physical silver simply exists for what it is. It is tangible wealth. It is insurance. I believe in the physical metal now more than ever before. And that is saying something. Because I have always been a staunch believer in holding the real thing. I own no ETFs. I'm not strictly against them for trading purposes, but for long-term security, they do not compare to the metal you can hold in your hand. And speaking of physical silver, if you are looking to add to your stack, check out my friends over at Summit Metals. They offer great customer service and a wide selection of products. You can find the link in the description below. But of course, as is always the case, before you buy any silver from anywhere, including the channel sponsor, do your own homework. Understand the risks. Yes, silver is a hedge against inflation and economic instability, but it is also volatile. It can be unnerving to buy 10 ounces of silver and watch the paper price drop $2 the next day. You need to have the mindset of a long-term holder, not a day trader. Here at Veiled Wealth, we have been tracking a specific phenomenon that is starting to define the silver market in early 2026, the stark divide between physical prices and paper prices. This divergence is highlighting potential systemic strains in global commodity trading that we simply cannot ignore. According to recent reports circulating across financial newsletters and platforms like X, physical silver is trading at dramatically higher prices in parts of Asia and the Middle East than the prices displayed on Western trading screens. While futures and spot references in New York and London hover near the 70 to 75 range, we are seeing wild swings in physical premiums elsewhere. Some sources claim physical silver is clearing at over $100 per ounce in select regional markets. Now, I believe there is truth to this. We have seen credible posts and anecdotal evidence supporting these high clearance prices. But what does this discrepancy actually mean? Is it a confession that the Western market is broken? This gap stems from physical shortages, intense regional demand pressures, and the decoupling of futures contracts from deliverable metal. As of early January, this gap has fueled speculation about bank solvency. If the banks are shorting silver at $75, but the real price is $100, they are underwater on a massive scale. This raises the question, could similar dynamics emerge in other markets, or is silver the canary in the coal mine? I think we need to be real about this. There's a lot of hype out there. Sometimes I fall into it myself because the potential for a squeeze is so exciting. But this channel, Veiled Wealth, is about checking our own biases and looking at the hard reality. The silver price that most investors see comes from futures and spot references on exchanges like the Comex and the London bullion market. These prices primarily reflect derivative contracts, paper versions of silver. They are often cash settled, meaning no metal ever moves. It is just exposure to the price. It is not tested to the core. As of late 2025 and early 2026, these benchmarks are trading in the low to mid-70s. These prices are used for hedging by miners and manufacturers. They are not retail checkout prices. When you hear claims of silver trading at $130 in Japan or $106 in Kuwait, you have to look at the context. These often originate from secondary market listings, retail transactions, or small lots. They often include taxes. For example, in Japan, the consumption tax is a significant factor. In China, while some say the Shanghai gold exchange price includes VAT, others dispute it. However, even if we strip out the taxes, the premiums are elevated. Tanaka, one of Japan's best-known bullion dealers, publishes retail prices that, when converted, imply an $83 per ounce price, not $130. So, while the global price might not be $130 yet, the fact that an $30 floor exists in Japan while New York trades at $75 is a massive arbitrage opportunity that screams market inefficiency. We have to acknowledge the physical supply constraints currently in force. Industry reports and dealer notices point to intermittent shortages of retail-grade bars and coins. Delivery times are lengthening. I know this anecdotally from talking to bullion dealers who are struggling to source product quickly. Refiners are selectively allocating metal to higher-paying regions. This is why premiums are rising, especially in Asia. China has essentially become ground zero for silver. Between the industrial demand for solar panels and the cultural demand for hard assets during economic uncertainty, China is vacuuming up silver. Add to that the seasonal buying in places like India, and you have a perfect storm for higher local prices. Western benchmarks, by contrast, are driven by high-leverage futures markets. Many people feel this is manipulated. Large volumes trade without immediate physical delivery. Physical markets are constrained by fabrication capacity, transport availability, and regulatory friction. This structural difference alone allows persistent premiums to exist without necessarily implying that the entire system is about to fail tomorrow. But it does show that the market is disrupted. We are seeing a natural reaction to an unnatural suppression of price. Now let's get to the heart of the fear. The bank short positions. Banks have been materially net short Comex futures. In the CFTC's Bank Participation Report dated December 2nd, the data shows banks holding a gross long position of about 25,000 contracts and a gross short position of over 67,000 contracts. This implies a net short of roughly 42,000 contracts. Since each contract is 5,000 ounces, the implied net short exposure is around 212 million ounces. That is a lot of silver. If silver prices rise significantly, that short position becomes a liability. But does this prove insolvency? Not necessarily. The data supports that banks are heavily positioned on the short side, but it does not prove they are unhedged. Hedging is critical for these banks. Just as a bullion dealer hedges their inventory to protect against price drops, banks hedge to protect against price rises. They might have offsetting positions in the OTC market, physical inventory, swaps, or options that are not visible in the CFTC report. So, the claim that banks are naked short, meaning they have zero protection, is unproven by public data. We can suspect it. We can theorize about it, but we cannot prove it from the Bank Participation Report alone. If silver repriced overnight to $200, it would certainly damage their balance sheets. But to claim it would wipe out Tier 1 capital instantly requires a bank-by-bank detailed analysis of their net risk collateral and hedges, none of which is public. We also have to address the history of manipulation. We all remember the case against JP Morgan, where they paid nearly $1 billion to resolve spoofing charges. Manipulation has happened. It was profitable. The fines were just a cost of doing business. But right now, there is no public regulatory finding that a specific bank is currently manipulating the market to the point of imminent collapse. Yes, margins have been raised. The CME Group posted this publicly. Many view margin hikes as a tool of suppression, forcing traders to liquidate positions when the price gets too high. It happened in 2011, and it is happening again. It is legal, even if it feels unfair to the retail investor. They do it to manage volatility, but the side effect is often a cooling of the price rally. Two concepts are driving anxiety right now: naked bank shorts and force majeure. The naked short theory suggests banks hold these massive short positions without the metal to back them. If physical demand surges, like we are seeing in China, banks could struggle to source metal for delivery. Rising prices would trigger margin calls, forcing them to buy back their shorts at higher prices, fueling a short squeeze. If the situation spirals out of control, we could see a force majeure. This is a legal clause that allows obligations to be delayed or canceled due to extraordinary circumstances. In the silver market, this would mean the exchange admits it cannot deliver the silver. They would settle contracts in cash, giving you dollars instead of metal. This hasn't happened yet. No major silver exchange has declared force majeure as of this recording, but it is a tail risk. It is the nuclear option. If it happens, confidence in paper pricing would evaporate instantly. The price of physical silver would decouple completely from the paper price. Even unproven theories influence markets because they change behavior. If investors believe force majeure is coming, they will demand physical delivery now. They will withdraw metal from the system. This creates a self-reinforcing pressure. It creates a run on the bank, or in this case, a run on the vault. This is why, here at Veiled Wealth, we emphasize that while these events are not guaranteed, the risk is higher now than it has been in decades. The stress is real. The structural deficit is real. We are in the 6th consecutive year of a silver deficit. That is a fact. So, could a silver price shock trigger a banking crisis? The silver market in early 2026 is experiencing heightened volatility and visible physical premiums. The divergence between paper and physical is real, but this reflects market structure, taxes, scarcity, and demand. It does not, by itself, prove systemic insolvency. Public data confirms banks are net short 212 million ounces. That can create massive stress during price spikes. But we do not know if they are hedged. Here's the bottom line. The banking system is resilient, often because the rules are written in its favor. They can change margin requirements. They can settle in cash. They can change the rules of the game in the middle of the fourth quarter. That is why you hold physical silver. Because when you hold the metal, you are not playing their game. You're holding an asset that has no counterparty risk. Let me know what your thoughts are in the comments section down below. Do you think the banks are naked short? Do you think we will see a force majeure event this year? I think holding onto your physical silver and using dollar cost averaging strategies is key. We are going to continue to watch these markets closely on this channel. I hope you found this video informative, insightful, and educational. I would like to extend a multitude of gratitude to each and every one of you for taking the time to watch. Please rate, share, comment, and subscribe. Until next time, keep your veiled wealth and your eyes open.